in assets that were worth nothing. You had the SPACs bubble, you had the crypto bubble, you had the meme stock bubble. Bond yields were low, credit spreads were low, in spite of high debt ratios. And the party, of course, went crashing last year because we had finally goods inflation that forced central banks to increase interest rates. And traditional investment advice is to try to balance your portfolio, 60-40, 60 equities and 40 safe bonds, or 70-30, or variants of it like Bridgewater's risk parity. They're just variants of the same thing. But the idea of doing 60 and 40 based on the view that historically there is a negative correlation between the price of bonds and the price of equities. When equities do well, like when there is risk on or economic growth, their price goes high, bond yields go higher, the price of bonds falls. So you make money on the equity leg and you lose money on the bond leg. When there is a risk of a recession, equity go down, but then bond yields fall and the price of bonds goes higher, so you make money on the 40%. But that assumes that inflation is low and stable. When, like last year, inflation starts to rise, equity do poorly because the discount factor for those equities and long-term interest rates is much higher. And long-duration assets like tech stocks or growth or VC do even more poorly because the long-duration assets are more sensitive to rising long-term interest rates. And that's why the Nasdaq last year fell 30%, while the S&P fell only 15%. But bonds actually do poorly as well, because bond yields going from less than 1% in US 10-year Treasury to 3.5% implied that the price of the bond fell 20%. So you lost more money on your, unquote, safe bonds than you lost money on the S&P 500. So last year, there was nowhere to hide. You lost money on public equities, you lost money on tech, growth, VC stocks, you lost money on private equity if you truly marketed to markets, you lost crashing 80-90% down for meme, crypto, and all the other speculative backbone like SPACs. You lost money on bonds, you lost money on credit because credit spreads widened, and of course even cash gave you a negative real return because of inflation. So I think the lesson the investors have learned is that when inflation starts to rise, the negative correlation between bonds and equities become positive, but positive in the wrong direction, meaning both of them go south. Sure. And that's something that people have to start to wear and find investments that can provide you a hedge against inflation and debasement of fiat currency. They exist, but they're not the traditional ones.
Dr. Rubini, you make a point that in this new normal, in this change in macroeconomic environment, inflation is likely to remain higher for longer.
Yeah.
And interest rates also may be sticky and may not come down in a hurry. Yeah. And the growth is likely to remain anemic.
Yeah.
In this kind of an environment, many of the investors who are listening to you right now, what would your advice be for equities as an asset class, high growth equities or value investing? If the environment remains so for next few years, what kind of asset classes do you think would do well?
Well, if I'm right, actually, and you don't have to be apocalyptic, I'm not expecting hyperinflation in advanced economies. I'm not even expecting double-digit inflation. Let's assume that the average inflation rate, say, in advanced economy is not 2, but it's only 6%. And given all the factors that are on the demand and supply side, I think the new normal for inflation is going to be 6%. That doesn't seem like a lot, but if inflation is 6, then 10-year Treasury yields have to be at least 8%, 6 for inflation and 2% real, because when inflation is high and volatile, the inflation risk premium has to be positive and high enough. Now, with 8% 10-year Treasury yields, then high yield and high grade bonds that have a spread over Treasuries have to be at least double digits. Mortgage rates have to be double digits. And of course, anything more risky than that is going to be high double digits and so on. Last year, when yields in the US went from less than 1% to 3.5%, bonds lost 20%. If they had to go from 3.5% to 8%, they would lose another 50%. And equities with a bond yield at 8% will have to be valued much less. In the 1980s, by 82, when we had high inflation and bond yields were much higher, the price-earning ratio for S&P 500 firms was 7. Today, is still 17. So in that scenario, even of a moderate inflation will be a bloodbath for equities, will be a bloodbath for bonds, there will be a bloodbath even for high-growing stocks like tech stocks, like it happened last year. Now, what's a hedge against inflation if you have to worry? You have to start to put your portfolio in your portfolio, assets that do well if inflation is higher. I would say, number one, I would put money into inflation index bonds that give you a higher return when inflation is higher. Two, if you go for short-term treasuries as opposed to long-duration treasuries, as inflation goes higher, the yield on, say, on a 1-month T-bill goes higher, but you don't have the price loss that you have on a 10-year. The price loss is much smaller, and the yield is much higher. So on fixed income, you have to be there. Two, I think that you have to be overweight in gold and some of the precious metals, not only because they're a good hedge against inflation and debasement of fiat currency, but we also live in a world where there are political and geopolitical risks. The political instability that might lead to people wanting to have safe assets like gold. And geopolitically, as the US is weaponizing the dollar, the strategic rivals of the US, whether it's China or Russia, Iran or Korea and others, will have to go into an asset that cannot be seized. Now, dollar can be seized, but also euro and yen and pound and Swiss franc can be seized, as we learned in Russia. So which is the only international store of value? Not a currency, it's a store of value that cannot be seized by, say, US or Europe if there is a geopolitical conflict, is gold. Of course, gold in the vault in Beijing or Moscow, not the gold in the vaults of the New York Fed or the Bank of England or somewhere in London. So I think that gold is a good hedge against inflation, against the debasement of fiat currency, against political and geopolitical risk, against even financial crisis, because in a financial crisis, sometimes your money in the bank may not be safe. So you want to be overweight gold, you want to be overweight, by the way, some of the green metals, because in a world of a green transition, where it's quite expensive to produce zinc, cobalt, and all sorts of green metals, the price of them is going to be higher, so you want to be there. And finally, among real assets, some forms of real estate. Real estate that is, how to say, resilient to climate change. You don't want to be having real estate commercial or
Do you know why I like to work in DLF Cyber City, Gurugram?